All right, Tousif, welcome.
Thanks for having me, John. How's everything on your end?
Uh, Doing well. Actually, out on vacation, but you know, always working.
Where are you now?
I'm in Lake Anna, Central Virginia, at the moment.
Oh, nice. You're
Yeah,
much closer to me then.
yeah. I'm going back up to Nova this weekend, so we'll definitely have to hang out.
Awesome. Shoot me a
Yeah,
text when you're here.
yeah, for sure. So Tousif, just wanted to bring you on. This is a little bit different than what I normally do. Typically, what we're doing is we're bringing people in to talk about how they got their first deal. But I think that there's a lot of value in understanding how you can get involved in real estate without having to do much. And so right now, what I'm doing is I'm bringing friends and family in on lending deals, and they have access to money that's all over the place. And one of the ways is through self-directed retirement accounts, um, and as well as stocks. And actually, those that are of retirement age are pulling money out of those retirement accounts to, spend. So, one of the biggest questions I get is how can you leverage real estate with a high W-2 income to offset as much taxes or pay as little taxes as possible?
Great question. Two folds to it and some limits. I might be ruffling up someone's feathers by saying this. Of
Mhm.
course, not everyone's going to like it. Not every kind of real estate is good for everyone in terms of if you only took this tax purpose perspective.
Mhm.
It's great for income perspective in a lot of different ways, but from strictly tax perspective, not all type of real estate is good for everyone. What do I mean by that? So say, for example, I have some clients that make more than $200,000 in just W-2. They have a decent amount of portfolio with long-term holds. They have $70,000 in negative K1, but they cannot take it because IRS allows you to write off like kind of income with like kind of expenses.
Mhm.
So what happens in this case is, okay, so you have $70,000 worth of negative K1, but you have a high W2. That's actually issued to you as a LP, which is a limited partner. You're not actively into real estate and you're not a real estate professional.
Mhm.
In those cases, it's just going to keep carrying forward. You're not going to be able to take them at that specific year. It becomes critical between 100,000 and 150,000. If you're managing long-term holds below $100,000, if you're actively managing it, you can take up to $25,000 from 100 to 150. If you're actively managing it, that $25,000 gets prorated. So wherever you are making that proration comes in. From 150 and beyond, it's only $3,000. So if you're looking into filing your tax returns, most likely you're going to have something that's passive activity loss limitation form.
Mhm.
So that's one of the things that you need to be cognizant of. But for W-2, however, if you're doing Airbnbs or actual hotel management, physical hotel management,
Mhm.
you're actively providing actual services, cleaning services, maid services, those kind of stuff. You're actually running as a business, not as a real estate investment. In those cases, you may be able to take them against your W-2. And especially for Airbnb, as long as you have more than 100 hours and no one else has more than your hours, then technically speaking, if you take the bonus, you can take that higher amount of depreciation or negative losses, not just depreciation, but the total amount of negative losses against your W-2 under certain circumstances and as long as the other conditions are met.
Got it. Okay, so there's a lot to unpack here. We have two types of income, right? We have active income, which is like your W-2, short-term rentals, hotels, and then you have your passive income, uh, which would be like being a limited partner in the syndication or owning long-term rentals. Is that right?
Long term or midterm.
Or midterm. Okay. Oh yeah, I was gonna ask about that. All right. So then W-2 earner making anywhere between 100 to $150,000 can take up to $25,000 deduction if they own long-term.
100,000 or less is 25,000.
Okay,
100 to
100,000 or less.
150, it
Okay.
becomes prorated between 25 to 3,000.
Okay, so it's a like a phase out
Yes,
between.
phase out.
Okay. Gotcha. And then anything over 200 is you have to have active, it has to be active losses.
No, so anything more than 3,000 or any amount. So if you want
Mm,
to take that extra amount, whatever that
mm.
is, you have to have it as an active business.
Okay. Right.
So whether it's your cap, so say for example, someone makes 125,000.
Hmm.
So between 25 and 3,000, whatever the limit is, you put it in the half. That's going to be
Hmm.
what is allowable to take for 125,000. But what's the caveat is if he has active income like Airbnb or hotel, he's actually actively managing. You're
Hmm.
running it as a business.
Yeah.
In that case, that limit is no more there. He can take
Right.
more losses and still take it against his W-2.
That makes so much sense because you see people that have multiple businesses, and then I can see now why that they're going into boutique
Yes.
hotels or hotels. Yeah. The
Yes. And
hospitality
also
industry. Okay.
buying businesses, active businesses, buying businesses is so much fun. I
Mm,
followed someone else's return this year. He made 160,000-ish. Um, One of the things he did is he's the owner operator trucking business, transportation business.
mm,
He bought a truck. We were able to write off, which is huge, not the 6,000 pounds, it's more than 14,000 pounds.
mm.
And we were able to write off under the 179, which significantly reduced his tax bill. And he ended up, I believe, not paying any taxes with his credits and such.
Oh wow. Okay. So then how are these high W-2 income earners using long-term rentals or passive rentals as a tax haven?
I never said that long-term
Oh,
rentals are passive tax havens.
right. But I'm trying to get to the point where if you say you have one person who's a high income earner and then their spouse is not, how
Okay,
does
so
that, yeah,
now
how does
that
that work?
becomes a question of if one of them is a real estate professional.
Mhm. And what's a real
Now,
estate professional?
so real estate professional is technically, on a very simplistic way, your primary source of income and your full-time activity is related to real estate. It can be through being a realtor, full-time real estate agent, or if you are a full-time property manager, or you're full-time doing real estate, whether it's leasing, you're flipping, uh, you're developing, your construction, you're managing, you're property manager, any of those kind of things.
Mhm.
So as long as one of the spouses are full-time real estate, I guess, real estate professional.
Mhm.
And technically speaking, if you look into IRS publication 925, it spells out to be more than 750 hours, which is roughly about 3 to 4 months of work, depending on how hard you work. Of
Mhm.
course, if you have a W-2, it's really difficult to justify. But if you're like, hey, I had W-2 for 3 months of the year, remaining 9 months, I left my job. So technically speaking, I am going to be qualifying for that 750 hours. So yes, in those cases, you are able to. But one of the things I would recommend is if you're investing into those syndications, make sure to have the K1s or investments done under the spouse or whoever whichever spouse is actually the real estate professional.
Mhm.
Technically speaking, it might not be the legal requirement, but it's easier to file with any of the most taxes. So say, for example, if you're someone's doing his personal taxes in TurboTax,
Mhm.
if they're trying to import, most likely they're going to have something that, hey, is the spouse or is the individual real estate professional? If you check it, it's going to allow you to take that extra bit of depreciation against the active income as well.
Got it. Okay. And then how hard do they scrutinize the real estate professional status?
Depends how big is it. And of course, if you're talking about IRS is bumping up their, I guess, efforts for auditing at the
Mhm.
moment. Uh, but technically speaking, the smaller the business, the more the scrutiny is. I know it sounds counterintuitive,
Yeah.
but the fact, I'm not saying that the big businesses don't get it, but typically, if you're looking into the audit percentage, typically C Corps get the least.
Mhm.
So technically, depending on how you're operating, say for example, someone has a management company. So just by turning it into a corp reduces your chances of audit based if you're looking just based on that statistics.
Yeah.
But of course, audit is not that statistics only. IRS
Yeah.
has the right to choose anyone and at any time.
Right. Yeah. Oh, that's interesting. Because when my management company was set up, it was a C corp, but I just didn't understand why. But now it
Mhm.
makes total sense. Yeah.
However, I want the good and the bad and the ugly thing. I also have my company as C corp. Now, C corp does allow a significantly bigger separation.
Hmm.
However, depending on how you're touching the money, you might be paying the double taxation.
Right.
So whenever you're doing this, make sure to strategize more with C
Hmm.
corp. And of course, with C corp, you have more options because, say, for example, a lot of people invest into stocks. So now
Hmm.
you actually own 100% of a stock, though. So technically speaking, you can take loans against your stock. So in that case,
Interesting.
even though you're not taking money out of your C corp, that
Mhm.
entire amount that you're getting, that's tax free.
Wow.
That's how I understand Elon Musk did bought the Twitter with $40 billion of loans against stocks.
That is crazy. Okay. That's something that is something new to me. Um, so how do you get around? Because if you have a C corp, don't you have to have salary? You have to take a salary, right?
Again, depends on, of course, you have to. Of course,
Hmm. Yeah.
there is the fact.
Hmm.
But like if you're talking about the starting couple of first year or two, your C corp might not be that profitable. There might not be
Hmm.
enough money to even pay a salary.
Right.
What happens then? So you're just surviving that years.
Hmm.
Now, of
Yeah.
course, as the company starts to make money, if you're trying to take money out, yeah, you should be paying yourself a salary. And
Yeah.
that's true for even S corps as well. So
Mm.
both S corps and C corps, you do need to pay salaries to yourselves if you're trying to take money. And the difference is with S corps, there's nothing called retained earnings unless it's grandfathered in.
Right.
But for C corps, you technically can have retained earnings, push the can of taxes a little bit further.
Okay.
So now now, of course, it also has a cap. You cannot just keep on accumulating retained earnings.
Right.
IRS is going to come in and start imposing penalties. But the fact is, it does have the opportunity to give you a few years worth of window. So whenever you're doing
Mm.
tax plannings, it's not only just the amount that you're going to be paying. There's multitude of things that are associated with it. So there's, of course, the first thing, very common thing is how much tax you're paying. And the second thing is also how you're paying. And the third thing is when you're paying. So say, for example, you owe $5,000 in taxes, but you took retirement distribution this year. So you're going to be paying 5,000 plus the amount on retirement distribution. So say, for example, that's another 2,000.
Hmm.
And on top of it, since you took the distribution from retirement account, if you're less than 59 and a half, which I feel like you are, the so there's another additional 10%. So what if you could shift the 5,000 to the next year?
Right.
So technically speaking, you're not paying a different amount, but you're paying it a different time.
Right.
That's where the tax planning can also happen.
Okay.
So that's exactly the same thing happens for capital gains. So if you're doing on seller finance deals,
Hmm.
seller doesn't necessarily always get a less amount in tax, but the capital gains he's getting is actually distributed over time.
Right.
So a lot of people have a misconception is, hey, uh, we're going to be only getting the amount or getting paid when I'm going to be receiving the full amount or more than my basis. No. If you're selling it as a installment sale, IRS does break it down to a few components. Your principal, your interest, your gains, all of those kind of stuff. And then the difference is how whoever is filing the taxes for the installment sale, they do need to distribute it out on those components.
Okay, that's really good to hear because I have decent amount of single family homes that I'm thinking about unloading, and I've made a lot of money off them just through appreciation and just lucky about when I bought them. And yeah, trying to figure out if I should 1031 them or if I should do like a seller finance because they all have like great rates. So um, yeah, having a tax strategist is definitely gonna help with that.
Yeah,
Um,
because whenever you're doing this, remember, you are going to be breaking your proceeds, whatever you're getting,
mhm,
in three different buckets. Now, can you delay it? Yes, you can. There's multiple strategies: lease to own or selling on a contract to deed on condition of not transferring the deed. So the issue in those cases becomes is at the end of the year, even though you're going to be getting the smaller amount of money, you're going to be paying the taxes for all of the years.
yeah,
Now
yeah,
you're thinking that, hey, is it worth it for me to just kick it down the can? But again, it might also be beneficial because it gives you time to say that, hey, after a certain amount of years, so say, for example, if you're doing a lease option,
mhm,
when the option is about to be executed, you have those much of years of time to think of a 1031 exchange.
yeah,
So even though technically you're getting the money, it's since it's a lease option, it's treated as a lease.
mhm,
But when you're going to be selling it, the 1031 exchange kicks in and you're not paying the capital gains. You're kicking it down the road.
yeah.
And as long as you keep kicking it down the road up until you're dead, that's it.
Yeah, it's just the game. How long can I delay paying taxes?
Yes. That's why I said that tax planning is not only just paying less amount of taxes,
Mm,
it's also about when you're paying the taxes.
yeah, so helpful. Yeah. Um, so this was really good information. I do have some specific situations that I want to ask you about because again, I'm in that mode of trying to help friends and family get into real estate and make money in the real estate industry. So one of the questions I have is if you have stocks, right? Um, if it's less than $100,000, is it worth it to do a loan, or how can I best, or what are my options to avoid paying taxes on any of the gains, but also use that cash to get into real estate lending?
So unfortunately, the 1031 exchange is now limited only to real estate.
Okay.
Even though stocks and cryptos in most cases are treated as a capital assets. Now, for crypto, depending on where and how you're getting it, crypto is treated as when you're mining it as an ordinary income, when you're selling it as a capital asset. So this is a little interesting thing.
Yeah.
But for stocks, pretty much it's a capital assets.
Mm,
For business stuff, pretty much capital assets, unless it's only having the real estate. So unfortunately, the aspect of rolling it over, which could have been the case that, hey, I'm having stocks on this, you open up a C Corp, I'm rolling it over to your C Corp.
yeah.
Unfortunately, we cannot do that. Uh,
Okay.
but as you mentioned, for high W-2s, pretty much the few options are the fact that you're literally taking loans against it. Now, the other one is not the best, but it's not for profit, it's a non-profit strategy. You can technically donate your stocks to a non-profit. But however, you cannot take distributions out of it, but you can be salaried employee of that nonprofit. So if you need to take money out of it, technically speaking, you're paying those taxes on that route. And not only you, maybe your children. So then you're still taking the money, but at a very lower tax rate. So say, for example, if your children are like 17, 18 years old, and you're paying them $20,000, $30,000 filing separate, depending on which stage they're in that case, it might be more beneficial to just transfer it to the nonprofit and then have them a salary. Especially this is true if you have a high W-2. Because if you're getting $340,000, then the amount of tax rate is going to be significantly different than someone getting the money out at 30, 40, $50,000 of tax rate.
So those are the options. So you could either sell it, take the capital gains, and then move it into lending or buying. You can take a loan against it, or you can donate it to Your own
Yes.
nonprofit. Okay.
Mhm. I mean,
Wow.
to be honest, I'm actually setting up my own nonprofit. That's one of the games I'm going to be probably working on.
Uh-huh.
Uh, of course, this year I'm learning about international taxes.
Okay.
The last few years was my focus on real estate taxes. So let's see what international taxes does bring in, because I'm learning a few pretty unique strategies if you're leveraging overseas stuff, but
Mhm.
it does become a little complicated. Those
Right.
are doable, but if you're just 50, $60,000, the expenses related to them is probably not worth it. But if you have a
Mm.
few millions of dollars, in those cases, that might be a strategy that's worth taking a look at it.
Right.
And that's
Yeah.
why you see a lot of international companies like Nike, Adidas, they have management companies in all those kind of countries.
They're playing the game at a different level.
Yes.
Yeah. All right, so that's that. What about for distribution? So I have someone who is of retirement age and he is pulling money out of an IRA. So it's all pre-tax income or pre-tax dollars. So when he's pulling it out, he has to pay taxes on that money.
Hmm.
What can he do if he's retired, no W-2 income, owns a couple rentals, but wants to offset that, wants to reduce his tax liability from the money that he's pulling out of his IRA?
So, of course, if it's already a regular IRA, you have very limited options. You just have
Hmm.
to eat the bite.
Yeah.
But if you're starting out, I would not even choose the IRA option.
Okay.
I would probably choose the infinite banking strategy with IULs or whole life
Okay.
with the life insurance options,
Hmm.
and then take loans against the cash value, which is
Got
tax
it.
free. And if you die, the distribution is also tax free. So that might, if you gave me an option, because I also had set up my policy. Of course, I'm not going to go to the debate of which one is better for whole life or IUL,
Right. Hmm.
because both of them I feel like has its own pros and cons.
Hmm.
It's just that each individual thinking how much trust they have on which system they can take it. But as long as you have cash value and you can take loans against it, that's what I would do. The second best option is at least the Roth IRA. It's easier, depends on how much you make. It might be easier to pay a little bit of taxes on the Roth IRA and then transfer it. But at the end of the year, whenever you're taking, or at the end of the years, whenever you're taking money out of it after the 59 and a half, all of those money is actually tax free. Uh, for the traditional 401ks and such, it's not that tax free, because when you're contributing it, you are
Hmm.
tax deferring it. So
Hmm.
technically speaking, that is saying that, hey, now you have to pay taxes. Now, someone like me who loves investing more than making W-2, I think that's a shitty strategy, because if you have that much of trust in the financial system,
Hmm.
which is supposedly only go up, never go down, and you're never gonna get hurt, that is hope that I'm not buying into. So that's why, of course, I do have those. I'm not saying I don't have those.
Yeah.
I do have those vehicles from my previous job. I just left my job as an engineer,
Hmm.
but from those money is something that I'm not banking on. Rather,
Hmm.
I'm more banking on taking control of the money and investing myself. And I don't know if you guys, if you saw yesterday, Bank of America had a huge glitch, banking
Oh,
glitch.
really?
Yeah, and it was showing no money in the accounts
Oh,
of
geez.
thousands of people. I was so afraid I don't even open my Bank of America account. I'm like, okay, let's have them fix it. But just in case if there was something issues, I am moving all my liquid cash into assets. So another thing is, technically speaking, cattle are treated as capital assets, especially if they're for breeding. So I'm moving my money into livestock as well. Because if you say, for example, if you have capital gains on your crypto stocks, you can sell a few cattle and get the capital loss and pay no taxes, because that's also a capital asset.
Right.
So
Oh,
that's
so
why. I
Yeah.
interestingly loved one of the statements of Robert Kiyosaki that he has more trust on the sperm of his Wagyu beef than the dollar bill. That's interesting, and it stick with me.
Yeah. So, I mean, cattle, I'm assuming that when you buy it, you can depreciate that asset, right?
Yes.
Yeah. Oh, that
I
is
mean,
amazing.
especially specifically for breeding purposes. It's not that if you have for entertainment purposes, no, that's not.
Mhm.
Specifically for breeders, that's treated as a capital assets.
How much is a cow typically?
Depends where you're buying it from. If you're looking into Alabama, Arkansas, maybe you can buy 70 to 100, $200 a head. And if you look talking about the DC area, it's about a couple of thousand, depending on how the weight is.
Oh, wow. I mean, just kind of like an off question, because where I live in Florida, I often see just, a few cattle here and there. You think people are just owning them just to have them as pets? They're just in the middle of nowhere. Or what do you think they're
Depends. I
doing?
mean, there are a couple of issues here. Now, some of them might not even be owned by anyone or claimed by anything.
Mm,
I had a friend who recently bought a land and there were cattle there for few generations, and the people they were not used to consuming those cattle.
mm,
Where my friend is like, "Hey, we love beef.
yeah.
You give us beef, I'm eating them all day. You tell me which recipe you want." So
Yeah.
now the issue with that was um, these cattle were like literally wild cattle. They never needed any vets. Their hoofs were never trimmed, anything like this.
Mm,
Those becomes a little different thing than when you're actually commercially doing this. So
mm,
now it becomes a question of purpose. That's a little bit tricky, but we can definitely sort those out. But long story short, to answer your question, are those just for pets? It depends. Are those used for breeding? Maybe,
mm,
because especially for the horses. So say, for example, in the Wild West, you have Mustangs roaming around
mm,
in the deserts or the valleys. Who owns them? Nobody. But technically, breeding horses are capital assets.
right.
But if you only have them for riding, they're not.
Interesting. Because you're still using the horse as some type of tool,
Mm-hmm.
but that doesn't count.
Mm-hmm.
Okay. All right. So going back to distributions from the IRA, if there's, let's say, a couple $1 million in there, if you were to pull all of that out, you're going to be taxed at a higher bracket than if you do a little bit at a time?
Yes.
Okay.
Yes.
So then you would you say that the smarter move, because if you're already retired, you already have money in there, nothing you can do about it, pull just a large amount out once, uh, up to a certain amount to keep your tax bracket low every single year, and then take
Mm-hmm.
that money and then reinvest it. Just bite the bullet, take
Yes.
that
Now
tax.
the issue
Mm,
is there's also another limit. If you're not taking money out enough, IRS
mhm.
is also going to tax you after a certain age. I believe it's 71 or 72,
Okay,
somewhere around that.
okay,
It's just because they feel like, hey, we need to have you taxed. So if you're keeping it more than that, we don't like it.
yeah.
So
So
you
the
need to
most,
distribute things out. So here's what I would do is take a little bit more, be full-time into real estate.
okay,
Now full-time real estate gives you the real estate professional status. Take
hmm,
those depreciation, keep carrying them forward up
okay,
until the time you have a bigger quote unquote income.
okay. Now, if real estate professional status was not on the table just because he's not interested in doing any work, would it just be pull the money out, take the hit, and then just make sure that you're reinvesting that money to turn the cash flow? That's the best way to do it.
Yes, pretty much.
Okay.
Because again, now you're still at the limit, especially how much you're pulling out from the IRA and such.
Yeah.
So
Okay. Okay.
remember that's also on the table of how much you are pulling out is going to be significantly depending on what your tax bracket is going to be.
Okay. Have you heard of this option to defer capital gains from the sale of stock if you're taking that money and putting it into opportunity zones?
Opportunity zones is different than DST. So there's
Hmm.
two elements of it. Deferring tax to capital gains to opportunity zones, deferring tax to DST.
Hmm.
Opportunity zones, and there's some funds, the capital gains in some cases reduced 50% or even zero is only for the capital gains of that real estate, not the capital gains upstream.
Okay.
However, properties sold under DST may be even qualified, I guess, qualified as some level of spread out, which is Delaware statutory trust. So now, can you do those? Yes. But how are you doing it? It also becomes another legal procedure. You have to set those up trusts up separately, and you're just more like similar to a capital gain, seller finance capital gains, but not exactly like this. You're using actual vehicle, separate vehicle like the trust instead of the regular note for a seller finance.
Got it.
So those two are different. But to answer your question, the opportunity zones, that is only true for the property that you are buying in the opportunity zone and selling it. You have to hold it, if I remember correct, 10 years
Okay.
on the opportunity zone, and you have to spend more than you bought it for. So if you bought it for 50,000, you have to spend 51,000 or $50,001 to
Yeah.
qualify for that uh, stuff.
Got it. Okay. That's good to know. Because I was worried that I was gonna have to go through that rabbit hole and try to figure all that out. But it seems like the best way to do it is either take a loan or just sell it, take the hit, and then turn it into a term of stocks. Take the hit and then just go and reinvest it, just knowing that you'll be able to make it more in the long
Yeah. And if you're young, instead of doing those, try to look into the life insurance. That might be a
run. Okay.
better vehicle.
Yeah, that's something I'm gonna be doing for myself. So offline we can talk about a good vendor.
Sure. I
Yeah.
mean, I also hold the license, but I typically
Oh,
have other people to do it. I just
okay.
help them to, because I'm lazy in some cases, I'm
Uh-huh.
effective in some cases. I have a few others up to friends who does the uh, IUL setup, the
Mhm.
Rockefeller Waterfall Method setup. So I have them do the paperwork. I'm the one
Okay.
who's helping them with the tax explanation and such.
Okay, can you explain the Rockefeller waterfall method?
So there's an interesting book, What Would the Rockefellers Do?
Hmm.
Of course, I feel like it's going to be not justice to say that in a few words,
Hmm.
because there's a lot of complications to it.
Right.
But to make things simplified, of course, don't take the word as literal.
Yeah.
Just for making things simplified for people,
Hmm.
it's more like they have a policy as soon as they have a family born in,
Hmm.
and it contributes to it. And after that, uh, it grows on cash value so much that they can take loans against it on a certain things like starting a business, getting a degrees, and so on and so
Hmm.
forth. And when they die, the policy is actually paying that back to the initial one.
Okay.
So it's literally getting into the bowl where you're actually having all those funnels of funds of things coming in
Hmm.
that then eventually the members can again take loans again. Of course, this is not the actual way it works, but it's more
Yeah.
like
High
a
level.
second grader simplification version. There's a lot of things that does go into it.
Yeah. Yeah, I remember hearing about something similar where one of the Michigan Jim Harbaugh was getting paid out through his life insurance, and then all that money is going to go to charity, and then there's all these things that had to get set up. But it was like a brilliant way to do it so that he would never have to pay that back, and then
Yeah,
his life insurance policy would just continue to grow and would pay it once he passed away.
yeah.
But yeah, very cool. I appreciate it. Thank you so much.
No
Um,
worries. Of course, I mean, again, as I mentioned, depending on where you are, Rockefellers use whole life, but a lot of people like, hey, IULs didn't exist then, so we want
mhm,
to do IUL. So that's where the moment you get into the nitty-gritties,
mhm,
definitely sit down with the professional because everyone's expectations, risk tolerance,
yeah,
situation is different. So also the trust that needs to be set up. If there's a charity component that you want, that goes in. That's why you see Rockefeller Foundations having so many universities and so on and so forth.
Yeah.
So there are certain ways things does work as long as you do it right.
Yeah. Well, I appreciate you coming on. Can you talk about what you're working on right now and how people can work with you?
Of course, up until 15th, I'm helping people file their taxes. That's for sure. The current goal is, of course, we set a goal about $10 million to save in 2020 for 2023, which is going to be, we're going to be filing for 2024. So now we're bumping it up to 25 million. Let's see how far we can get for 2024-2025 season. I'm gonna get, I guess, calculate most of stuff, but I think our last time I checked was close to about 6.5, 7 million that we
Yeah.
did.
Mhm.
But let's see how. I'm pretty hopeful that we could probably knock off the 10 million, but we'll see. In terms of planning, we are helping people with planning, and especially if you're growing really fast. We also do provide fractional CFO services
Nice.
and would be more than happy to help you with those. And the biggest educational term that I'm focusing on this year is, as I mentioned, international taxation, how we can help overseas. Because I know US is a great economy, but can there be other options? If there are, why not take it? So a simple example is Puerto Rico.
Mhm.
Might be a very good option, depending
Yeah.
on where you are, what you're doing. And lastly, for my personal self, I'm working on a few projects on Hunger-Free World. I am investing into a few charitable organizations and research projects on systems to streamline the supply chain of food, especially safe food for antibiotic-free, antibiotic residue-free chicken, beef, mutton, vegetables. We're trying to also work on traditional breeds, traditional ways, source of food where we had significantly better amount of nutrition than the GMO products.
Mhm.
That's why my
Very cool.
grandfather could break his coconut with his teeth and arms. But it was difficult for me to even try that. So,
Wow, that is
those are
amazing.
some of the
Yeah.
things that I'm looking at.
Okay, cool. So how can people reach out to you?
I'm pretty active in Facebook,
Okay.
and I always drop my number as well. Uh, Maybe you have my number, you can share those as
Yes.
well.
Yeah, so we'll have those in the description so you don't have to go and spell it out for everyone.
Sure.
Well, dude, I know it's right around busy time, so thank you so much for coming on and answering my questions. Um, Again, thank you.
Absolutely. If you have any other questions, feel free to reach out. You have my number, brother.
I appreciate it. Thank you.
Thank you very much.
All right, take care.
Bye.